Good morning or good afternoon, everyone, and thank you for joining us today for our Innovation Fireside Chat. My name is Andrew Stolfi. I'm the director of Oregon's Department of Consumer and Business Services, which is the state's largest consumer protection and business regulatory agency. The divisions within our agency regulate the state's financial and insurance industries, workplace health and safety, and building safety. And one of my primary duties is to serve as the state's insurance commissioner. In this role, I work with our Division of Financial Regulation to help protect Oregon's access to fair insurance products and services, as well as supporting a positive business climate. The team and I love our jobs because we know that if all Oregonians have access to the best financial and insurance products and services available, they will be able to fulfill their financial goals. Getting access to new, innovative products is, of course, key to this. So, in 2019, we launched the Oregon Innovation Hub to help insurance, financial, and technology companies bring innovative products and services to Oregonians. Simply put, we want Oregon to be the first choice for businesses to bring their ideas, and for good reason. Our state's large, diverse landscape and mix of coastal, rural, and urban populations makes it the perfect place to introduce innovative ideas and solutions. As regulators, we are here to help businesses navigate state guidelines to effectively implement new products and services so that Oregonians can see them, use them, and enjoy them first. One goal of our Innovation Hub is to help drive thoughtful conversations about the future of these industries. So in 2019, we held our first Innovation Forum in Oregon. The event brought together thought leaders and innovators from financial services and technology industries to talk about the future of financial services industry and how blockchain technology will shape how we pay for products and services, invest, and save for tomorrow. Our innovation forums are intended to be a time to drive conversation and network with one another. COVID-19 has altered and delayed this focus a bit, but we believe this is still a place to drive meaningful conversation about the future of our financial industries and how the state can help support innovative ideas while ensuring new products and services are safe and equitable for all Oregonians. It's this interplay between supporting innovation and protecting consumers that's the center of our discussion today. So as you know, the amount of data available to insurance companies has soared in recent years, and it continues to grow at astronomical rates. Data is, of course, necessary for predicting risk and effectively pricing the insurance products that we all rely on. And the algorithms used by insurance companies are dynamic tools for identifying correlations in massive data sets to help underwrite and price insurance policies. Artificial intelligence undoubtedly provides great potential, but it requires ethical accountability to ensure that unfair, discriminatory outcomes are eliminated from risk calculations. In Oregon, we're committed to dismantling the structures of racism that have created disparities in virtually all our social systems and structures. We are changing how we listen to, engage with, respond to, and support our Black, Indigenous, Latinx, people of color, and tribal members. Last year, our governor, Kate Brown, convened a Racial Justice Council to develop recommendations for dismantling the structures of racism. Our Division of Financial Regulation has been contributing to this work in several ways for some time, including by focusing on ways to address disparities found in auto insurance. For example, in 2018, we directed auto insurers to accommodate people who identify as non-binary in insurance applications, rating systems, and rating plans. That work started a discussion among public and private stakeholders about incentivizing safe driving behavior and removing potential discriminatory practices that raise auto premiums for Black, Indigenous, Latinx, people of color, and tribal members. Cassie Soucy, policy analyst for our Division of Financial Regulation, will talk about that bill and our work at the division in a little bit. We've also engaged for some time in the use of big data in rating models, and we're glad to have worked with the NAIC in developing and approving its new AI principles. For those that didn't follow that work, these are 5 interrelated considerations for the appropriate use of AI under the acronym FACTS, which stands for Fair and Ethical Applications, accountable to regulators and stakeholders, compliant with existing insurance laws, transparent in their application, and safe, secure, and robust in protecting consumer data. These principles are intended to help AI development adhere to existing rules and laws and are consciously designed to avoid proxy discrimination. So turning to our discussion this morning, we have a great panel of speakers ready to talk about insurance, which as we all know is a business where success depends on how well a company can predict and therefore price risk. Algorithms are intended to be a neutral tool that helps insurance companies analyze ever-increasing data to calculate risk. At its best, artificial intelligence can teach itself to almost perfectly calculate risk. At its worst, it can hide price discrimination and disproportionately affect low-income and minority consumers. Today, we're fortunate to have 3 people here to chat with us about AI and its potential. Each person will spend a few minutes discussing some theories and ideas related to their work with AI. We'll then have a broader discussion between the panelists before we wrap up the program by diving into your questions. So please join me in welcoming Daniel Schreiber, Birny Birnbaum, and Cassie Soucy. So Daniel is the CEO and co-founder of Lemonade, an insurance company powered by AI. Daniel will discuss how, with enough data, AI can teach itself to eliminate bias in insurance and perfectly predict risk for each person. Birny Birnbaum is the director for the Center for Economic Justice, a US nonprofit whose mission is to advocate on behalf of low-income and minority consumers on issues of availability, affordability, and accessibility of basic goods and services. Birny will talk with us about consumer protection and how we need to better understand data and algorithms in order to remove bias from insurance. And finally, Cassie Soucy is a senior policy advisor for our Oregon Division of Financial Regulation. Her focus is on property and casualty and health insurance issues. Cassie will discuss some of the work that is taking place at the state and national level to set regulatory guidelines to protect consumers to help insurers remove bias from algorithms and rating factors. Thank you for joining us, Daniel, Birny, and Cassie. We look forward to hearing from you today. Daniel, the floor is yours.
Good morning, Andrew. Thank you so much. And it's so fabulous to have these kinds of forums where we can think together and share ideas. The last few years and decades have been so transformative to the world at large in terms of the technology. And no doubt the decades before us will equally be so. And I welcome the opportunity to meet with yourself and Cassie and such luminaries as Birny and discuss some ideas. I'm something of a newcomer, both to insurance and to this thoughts track. So I hope you'll excuse me if my thoughts are half-baked. They are in any event well-intentioned. What I'd like to do is use some slides to talk through the ideas that I want to present or share. So let me just go ahead and share my screen. Okay. You can see the slides okay? Okay. So let me say that we face big challenges. Today we price personal lines with filed rates, simple kind of lookup tables. But as you said, Andrew, when we have millions of data and when the data is dynamic and changing, lookup tables really don't stand a chance against that kind of torrent of information. In other jurisdictions, like in the EU, insurance companies do already use dynamic pricing and black box algorithms subject to certain oversight. In the US, the filed rates and forms methodology really does inhibit that, which could be good news or bad news. It gives us time to pause and think, but it also means that the current structures don't necessarily scale to the future that we face. And as we look at this torrent of information coming, it can be daunting. You can feel like there's a loss of control. The methodologies, the disciplines, the laws that we have in place were not put in place for this. And therefore, a quick reaction, a knee-jerk reaction, an understandable reaction would be just to stop it, to say this is all well enough, leave well enough alone, and we're not going to change anything. We're going to stop the adoption of these kinds of algorithms. The case I'm going to make is that actually we should be doing the opposite. We should be embracing them, and that we shouldn't start this discussion piecemeal, looking at this algorithm or that, this regulation or that. But in forums such as these, we get to the opportunity to soar and to really think about what is the terminus, what is the destination, what is the endpoint that we seek, and to formulate a strategic vision for how data, analytics, statistics, and insurance can continue to co-evolve in the decades and centuries ahead, not just in the months and quarters. So I will be advocating for embracing these new technologies, and I'd like to argue that thoughtfully done, these technologies will be a boon for fairness. That those of us who care most about fairness and racial equality and all other forms of equality should really look at ways in which we can embrace these technologies in order to overcome issues of proxy discrimination that can plague our sector today. The way I tend to think about our approach to data and statistics is to think about them somewhat artificially as evolving in 3 phases. The reality is obviously more complex than that, and they bleed into one another. But broadly speaking, up until the scientific revolution, up until Fermat and Pascal came up with probability theory as we know it, and Bernoulli formulated the law of large numbers, all in the 17th century. Up until that point, insurance companies existed, but they really priced based on commercial negotiations. They didn't have the tools to assess risk. They used intuition, but basically they treated all of humanity as a monolith. I have a picture here of Henry VIII. He sold annuities, and he would charge the same amount for the annuity whether you were 7 or 70 years old, quite oblivious to the radically different risk profiles in life annuities under those circumstances. And I represent this as a single block, and I'm going to spend no time on that. With the scientific revolution, the modern insurance companies were born. Many insurance companies today still date back to the late 1600s. And that's when suddenly this new technology evolved that allowed us to chunk humanity into groups and to use data and probability to do that in a scientific way. And while some things have changed, broadly speaking, we are still using the same methodologies today, and that's what I'm calling phase 2. Phase 3 doesn't exist, but it would be a phase in which we really drive the adoption of the digital revolution to allow us to use millions of data and to have those crunched by machine learning rather than by humans. We are at the cusp of that, but I will be talking about what may be possible, not necessarily this year, but in the years to come, and talk about that as the new trajectory. So I'm going to contrast phase 2 where we are and phase 3 where I think we should be going. So let me talk about phase 2. In phase 2, we chunk humanity into groups, best, good, bad, worst, what have you. And we use data and statistics in order to do that. And what we look for is expected loss. And this is the consensus among insurance regulation. In fact, it's required by law. So I will charge like risks, like amounts. And that's what we define today as fair. Fair is charging somebody the same per unit of loss, but not per unit of coverage. This is important, and I'll come back to it towards the end as well. Let's just think through the implications of that. So 2 people buy the identical piece of property, in this case a car, but it could be homeowners insurance, it doesn't matter. And here I've got Jack and Jill. They bought the exact same car on the same day from the same dealer. And we are quite okay with the notion that the insurance rates for identical coverage may differ and may differ significantly. In my case, Jill is charged $900 and something and Jack over $1,300. Now, why is that? Why are we okay with the notion that we're going to charge 2 people different rates for the same coverage of the same property? How do we determine how to discriminate between these people? Well, there could be any number of factors, but in answering the question of why are they being charged different rates, one answer may well be Y in the sense of the Y chromosome. Jack is a man, Jill is a woman, and the statistics on this are pretty stark. So here's an article from less than a year ago in the New York Times talking about the propensity of men and women to have crashes. So it turns out that male drivers have twice the rate of fatal accidents per mile driven than women do. And when you move into trucks, it's a 4x increase. And when you move into motorcycles, it's a 12x increase. So it would not be shocking if we knew nothing else about Jack and Jill other than the fact that Jack is a man and Jill is a woman, based on these kind of data, it would make a lot of sense to distinguish between how much we charge Jill. Jill is a woman, women drive more carefully. Jack is a man, men have more crashes. So certainly we see a system developing, and indeed most states, including Oregon to the best of my knowledge, allow gender as a pricing factor. It is statistically sound. This is driven by data, by the numbers. But is it fair? Is this a desirable outcome? Is this the terminus, the destination that we want to get to? And I don't think it is. So I've drawn here, these are hypothetical graphs, the data is made up, but risk curves of, bell curves of what kind of risk women pose on the roads and what kind of risk men pose on the roads. The average risk in my model here on the risk between 0 and 100 is 50. And the average man has a risk factor of 60. The average woman has a risk factor of 40. Which is why, indeed, if we know nothing other than the gender of the customer, we should be charging Jill less than we are charging Jack. But note that we're really tarring all men with the same brush, because the worst of the women drivers are riskier than the average men, and the best of the male drivers are less risky than the average woman. So we are treating people who may be actually excellent drivers among the male cohort the same as the average man. We are applying to them the gender average. But as I say, if Jack actually is here on the continuum, he's being hurt by this. And if Jill is on this part of the continuum, really the prices should be reversed. But we don't know that. All we know is that Jack is a woman, a man, Jill is a woman, and we charge them based on that pricing factor. Now, it's important to note on this graph as well, and this is true of gender differences, of racial differences, and a bunch of other differences, that there are differences between groups. The kind of risk that women pose on the road and that men pose on the road are indeed distinct, but that the differences between members of the cohort is greater still. So the differences within a group are actually greater than the differences between groups. A fundamental and important notion for the direction that we want to take this whole industry. Now, you may say, okay, well, we don't like that at all. Maybe Jack is being discriminated against for his gender. Maybe we won't allow gender-based pricing, and you could replace this with any other protected class. And I'd have to ask two questions. One, is that fair? Is that actually a desirable outcome? Because at the end of the day, women are more careful drivers, and should we not find a way of passing on those savings? And secondly, is it actually possible to entirely separate out from our data sets not only gender, but things that proxy gender? And just to be playful, okay, we're not going to allow gender, but can I use shoe size as a pricing factor? Because I will be able to show with tremendous statistical significance that people with larger shoe sizes are greater risks on the road. And if you say, I don't want to do shoe sizes, how about reading materials? And you could go on and on. Do they drink Coke Zero or Coke Classic or any number, height, voice pitch, so many other factors that will proxy male or female customers and indeed will be predictive of car crashes. An interesting one, and may seem less absurd, is how about a history of car injuries? Well, that sounds like a good pricing factor before you find out that women are actually 47% more likely to suffer severe car injuries. And that is because cars were designed with male dummies rather than the female one that you see here. So here we see an interesting concept. If the previous concept that the magazines was a proxy for gender, what we're seeing here is an inherited bias. So you'd start seeing women indeed suffer more injuries, but they suffer those not because they're less careful drivers, but because the cars were designed for a larger frame. So the broader point I want to make here is that the phase that we're broadly in today has a structural problem. This is not incidental. This is built into the very way in which we think about pricing and bucketing risks. We use a few data, enough data, so that a regulator can review them in a lookup table. And those data, because they are relatively sparse, will almost inevitably lead to relatively crude groupings. And relatively crude or big groupings create two big problems. The first is intra-group, within the group. So if you've got a group, for argument's sake, that proxies gender, or as regulation actually allows gender, is gender, we see that we're treating Bob and Jack the same just because of their gender. But as we saw before, Jack might actually be a very careful driver. And the second, you're imposing a uniform rate on a non-uniform group. That is literally the textbook definition of unfair discrimination. And we allow it by law only to the extent that it's impractical to do any better. But what was impractical once upon a time is not impractical today. So I think we have to take another look at this intro group, that very idea that we are tarring, in my example, all men with the same brush, that we are taking the average man and applying it to all men to the benefit of some and to the detriment of others. So that's the intra group. And then of course, there's the inter group. So now we're pitting, in my example, men against women, but as I say, this would apply broadly to other classes that we want to protect and care about. And when we do this, we may find that even in things that we don't intend, gender, we actually ask the question, but even in other places, we'll find that there are proxies for protected classes. And this might be penalizing people in ways that we didn't intend for their gender or for their race. And again, this is not incidental. I think this is almost inevitable when you're just using a few data points. And this is similar to when we meet somebody and we only get an external impression of them. We use those first impressions often in a detrimental way to form a first impression, whereas, and oftentimes it will be based on externalities, the color of their skin, their age, the facial elements, the gender. And only once we push past those and we actually get to meet the person beyond and we get many, many more data, are we able to overcome those and form a much deeper understanding of the human being that stands in front of me. So what we really need to do, and this is where we start moving from phase 2 to phase 3, is break up these groups. We don't want big monolithic groups that have a high risk of both proxy discrimination and of being unfair to people because they're placed in it without being uniform people. And that brings us to what is beginning to be possible and what I think ultimately is desirable. So phase 3 is about crushing, using the power of machine learning and data to crush apart each of those groups, to break them up into their component parts, and to keep doing that, to relentlessly use machine learning in order to divide and split these coarse groupings. And the fantasy, and we're far away from it, but the terminus, to answer my question, is to get to a group of one. To stop looking at humans as being groupish and members of a gender group or a race group or any other groupings that we choose to put them in. And I think the fantasy, the dream has to be able to look at an individual as an individual and not as any of those external or superficial things with which we group them today. And here we do get a little bit philosophical, and I think it's worth spending time on what is the terminus, what is the desired point that we want to get to. And I, for one, would subscribe wholeheartedly to the Martin Luther King dream of not judging people by the color of their skin, but by the content of their character. And being able to go pierce through all of those superficialities and get as close as we can to understanding the human being standing before us and the risk that they pose. And if we're able to do that, if we're able to treat each person as an individual, that would leave no room for adverse selection. It would neutralize proxy discrimination, let alone overt discrimination. And it would be the ultimate fulfillment of the legal mandate that pricing should reflect with reasonable accuracy the differences in expected loss. So that is really the destination, I think. So a couple of points in getting there. The one is just to reinforce the notion that group size matters, and that the smaller the group, the less chance there is that we'll be discriminating in a way that is unfair. So rather than thinking about women as a risk factor or as a pricing factor, how about we break that up into 10,000 more dimensions so that the womanhood is entirely superficial and unnecessary, because we're getting down to how well does Jill actually drive, rather than looking at her gender or other elements of our identity, and same for any other protected class that we might be looking at. So splitting groups, getting to the individual, the smaller the group, the less discrimination, and certainly unfair discrimination will be, and will be much closer to judging people by the content of their character. A broader point to make about this is that if we actually do that, if we use big data to break up these groupings, we will end what I call the tyranny of averages. So before we're treating all men as average men, all women as average women. I'm simplifying, but you understand the broad point, hopefully, that I'm trying to make. Whereas in phase 3, as I'm defining it, averages become unimportant. They are a facet of the world, but they're not a facet of our pricing. So if we do break apart these groups and get down to the individual, men on average will still pay more because men, in fact, crash more often. But equally, safe drivers will pay the same per unit of risk, regardless of their gender. And in phase 3, these two apparently competing statements can coexist. Let me talk you through that. So now we don't just look at gender, we're piercing through those groupings and looking at the individual. And we're pricing each person based on their risk. And in phase 3, we get to understand that Jack is actually a pretty good driver and we charge him accordingly, and that Jill is actually a pretty bad driver and we charge her accordingly, reversing today's pricing. And we do that for every human being along this entire continuum. Now, the problem that we saw in phase 2, where good men are charged as average men, disappears because in phase 3, all men or people are treated as humans. But note that the average will still be higher for men than for women, because the series, when you aggregate it, the series will still add up to 40. The average score for women will be 40, and the average score for men, in my example, will be 60, but nobody will have that applied to them. In phase 2, the average is applied to everybody, and in phase 3, it's applied to nobody. Averages stop having any hold over us. And that's why in phase 3, averages become an output, not an input, and that is why disparate pricing becomes uninteresting. I'm pricing people individually, and the fact that women on average are charged less than men is irrelevant because I'm not charging people based on that average. I'm charging it based on who they are as a human, the content of their character. So disparate pricing becomes noise. It's no longer a signal. Well, then how do we decide if we've got a problem? We can't just hand this over to the black box and say, hey, you do your thing, crunch numbers and charge as you will. We have to have a way as an industry, as regulators, as companies, to ensure that the algorithms are fulfilling the potential as I'm outlining it, and they're doing what we want them to do. So how do we audit them if we can't have simple lookup tables and filed rates and forms, but there's an algorithm that we don't really understand that's using millions, sometimes billions of pricing factors in real time and crunching them in ways that are superhuman? Well, you can look at disparate loss ratios. I think this is a fundamental breakthrough for how we think about the next phase of the evolution of our industry, but it's really simplicity itself. Today we look, as I say, we audit rates and forms, which is a really tough way to ensure fairness. But fundamentally, what we're looking for is not uniform pricing, it's uniform pricing per unit of risk, which would mean uniform pricing per unit of claims. Now, that has a name, it's called a loss ratio. And what we really should be looking for is uniform loss ratios across groups. So this is what it would look like. An insurance company would have to report with whatever frequency regulators wanted, and based on any classes that regulators wanted, what do the loss ratios look, not just at the aggregate group, but by gender or by race or by any other protected class. And what regulators will be looking for is, are there classes that have statistically significantly lower loss ratios than others? And if they are, they're being overcharged because per unit of risk, they're paying more. And I know this simply by looking at their loss ratio. I don't need to look at whether the pricing was fair. Maybe men should on average be charged more, but that would reflect itself in the fact that claims to men would also be more, and the one would balance the other out, and the loss ratio would be consistent with women's loss ratio, even though women are being charged less. That puts insurers in an unenviable position of being able to use such a simple algorithm, potentially in real time and without having to do much hard work, in order to check that the system is really producing results that we feel proud of. And the amazing thing is it catches pretty much all forms of discrimination that we don't want. Whether the problem is that we're charging people too much or we're paying them too little, whether it's in pricing or in claims, the ULR, the uniform loss ratio, will discover it, whether it's an inherited bias or an inherent bias, whether the discrimination is explicit or by proxy, doesn't matter. This won't lie. If I'm charging people more per unit of loss, the uniform loss ratio test will reveal it. And so I want to end where I started, talking about the destination and the optimism that I feel coming into the next eon of insurance, if you like. Plenty of details remain. There are various ethical and other considerations that maybe during the discussion I can layer on top of this. But I do think it will be a real boon for fairness if we use algorithms and systems like the ULR test to keep algorithms honest. We'll be able to upgrade the fairness of our industry dramatically. So back to my opening 3 phases, humanity as one big monolithic group. Then in the last few hundred years, we are using statistics, probability theory, and basic data to create relatively crude groups. And in the future, and this is the terminus that I'm arguing for, we get to the point where individuals get rated based on their content of their character. What kind of risk they, not a group of broadly or superficially similar people, but they represent. Now, getting there moves us from requiring no data, Henry VIII, to requiring few data today, and historically the last 300 years, to needing really very big data going forward. And that in turn means that we have to move from a system that requires no real intelligence to one that may do with human intelligence, to one that absolutely needs to adopt artificial intelligence, or else there's no way to crunch that big data. But I think it's worth it, because if we do this right, where we end up is we move from a system that was frankly dumb through no choice of the people, but they just didn't have the basic inkling of probability theory, to a system that is in existence today that I regard as maybe the best thing that we had up until now, but as dangerous. And we saw this with a woman-man example that I gave earlier, and we could apply any other protected class that we want, and ultimately hopefully drive us to a place that is desirable, where again, harking back to Martin Luther King, we judge people not by the color of their skin, but by the content of their character. Thanks, everybody. Those are my opening remarks for today.
Thank you very much, Daniel. That was very interesting. And there's some questions that have been coming in through the Q&A. I'd encourage people to keep putting those questions in. We'll come back to that in a little bit. We'll get through the rest of the panels first, and I'm going to turn things over right now to Birny. Birny, the floor is yours.
Well, good morning, good afternoon, and thank you for inviting me to join this discussion. Appreciate it. For those of you who don't know about the Center for Economic Justice, I think Andrew gave a brief overview of us and about me, but I did want to touch briefly on why we work on insurance issues. And the reasons are twofold. One is that insurance products are essential financial security tools for individual and community economic development. And the other is that insurance is the primary institution to promote loss prevention and mitigation, resiliency, and sustainability. So these are even more important. The role of insurance serves low and moderate income consumers to a greater extent than it does more affluent consumers who need insurance a lot less. But we work on this to make sure that this essential financial tool is available to low and moderate income consumers. So let me start with some basics. What do we mean by bias? If we're talking about bias in AI, what exactly do we mean? So I'm going to suggest that there are 2 types of bias that we're actually talking about. One is statistical bias that produces flawed analysis and flawed algorithms. And the other is bias on the basis of a protected class characteristic. And these 2 understandings of bias track insurance definitions of fair and unfair discrimination. So if you look at rating statutes and other insurance statutes, you'll see the rating statutes define 2 types of unfair discrimination. One is actuarial. There must be an actuarial basis for distinction among groups of consumers. And 2, there are protected classes, distinctions among groups defined by certain characteristics, race, religion, national origin, are prohibited regardless of actuarial basis. And then there are the unfair and deceptive trade practices statutes, which typically define unfair discrimination as distinction among groups based on a protected class characteristic. So I think it's interesting to ask, why are there two types of unfair discrimination in insurance? What's wrong with just having unfair discrimination on the basis of an actuarial analysis? Why not discriminate on the basis of race if you can demonstrate that there's a distinction in expected claim costs? So I'll answer that question in a minute, but let's first look at how bias might enter a statistical or actuarial analysis. Historically, insurers analyze one characteristic at a time in relation to the measured outcome. And this would be, I guess, the early part of what Daniel talked about as phase 2. And this would be where an insurer might look at driving age versus auto claim frequency, marital status versus claim frequency, or rating territory versus claim frequency. Each of these represents a one-to-one or univariate relationship. But each predictive variable may be replicating part of another variable because of correlation between the predictive variables, or it may be biased because of different distributions of risk characteristics within other risk characteristics. In statistical terms, there may be spurious correlations. So for example, driver age and marital status may be highly correlated, or the distribution of exposures by marital status and driver age may vary considerably across rating territories. So what might show up as a difference in expected claims based on marital status may simply be a different distribution of driver age and marital status across territories. So how do we eliminate correlation among predictive variables? And this is really not new. Insurers have started to do this for 30 years, at least on the property casualty side. And it's the introduction of multivariate analysis. The original sort of big data in insurance was the introduction of credit scoring. With credit scoring, that really turned on the light for insurance companies to start using multivariate analysis when they didn't have enough data to do a traditional actuarial analysis broken down by all their rating classifications. So insurers use a variety of techniques to eliminate correlations among predictive variables in order to isolate each individual predictive variable's unique contribution to explaining the outcome. So here's a simple illustration of a multivariate model. So let's create a simple one where the big X's, X1, 2, and 3, are predictive variables. And let's say their age, marital status, and credit score. And we're trying to predict Y, the frequency of an auto claim. And let's assume that all 3 X's are statistically significant predictors of the likelihood of a claim, and their B values, their coefficients, are how much each X contributes to the explanation of the claim. So the B values can be tested for statistical significance. How reliable are these estimates of the contribution of each X? And by analyzing these predictive variables simultaneously, the model removes the correlation among the predictive variables. So the correlations between marital status and age are removed, and the duplication that you would otherwise encounter with a univariate analysis is eliminated. So let's take this one step further. Let's talk about control variables in a multivariate insurance model. Suppose that an insurer wanted to control for certain factors that might distort the analysis. For example, an insurer developing a national auto insurance pricing model would want to control for different state effects, like different age distributions, different minimum limit requirements, and differences in jurisprudence across the states. So the insurer might add one or more control variables. And a control variable is simply another of the predictive variables added to the model. And we'll call this one state. And by including state as a control variable, the correlation of the X's to state is statistically removed, and the new B values are now the contributions of the X's independent of their correlation to state and to explaining the likelihood of a claim. Now, when the insurer deploys the model, it still only uses the X variables, but now with more accurate V values. In other words, the control variables are used in the development of the algorithm, but they're not used when the algorithm is deployed. Okay, so now what about the protected class prong of unfair discrimination? So I'm going to use proxy discrimination against the protected class and disparate impact to be the same, meaning discriminating on the basis of a protected class characteristic using a proxy for that protected class characteristic. So I hope we agree that denying coverage or otherwise discriminating against consumers because they're Black Americans or evangelical Christians is unfair discrimination in insurance. Suppose now that we're in an era of big data where insurers have access to massive amounts of personal consumer information, that I found a perfect proxy for either of these protected class characteristics, and the effect is identical to discriminating directly on the basis of the protected class characteristic. Should a regulator stop the use of these proxy variables on the basis of discriminating against the protected class? Well, the insurance industry trade associations say no. They argue the regulator has no authority to do that. So let's get back to that question I posed earlier. Why do we care? Why do we have two types of unfair discrimination in insurance? Why don't we just rely simply on an actuarial basis? And the answer to that is the existence of historical discrimination, intentional discrimination based on certain characteristics, discrimination that violates state and federal constitutions, doesn't disappear just because you say we're not going to discriminate on that basis. The recognition is that historical discrimination has long-lasting effects that disadvantage those groups. Stated differently, you can't enslave a population for 200 years and then expect the legacy of that enslavement will disappear overnight. You can't have Jim Crow laws for a century and expect the impact, that intentional discrimination to disappear overnight. And we see that impact of systemic discrimination today. We see it in policing. We see it in the impacts of COVID, both on the infection rates and the access to medical care. That's what we mean when we talk about systemic racism. We're talking about the racism that continues to pervade our society because of the historical intentional discrimination and the effects of that. And that's why we have two prongs of unfair discrimination. The discrimination against the protected class means that we don't want to continue to discriminate against groups of consumers, groups of human beings, simply because they have been historically discriminated against. And there are numerous examples of insurer practices that continue to have a disproportionate impact on the basis of race throughout the insurer's operation, not just pricing, but marketing, claim settlement, anti-fraud, and investments. Examples that practices that have disparate racial impact include credit-based insurance scores, customer lifetime value scores, criminal history scores. And why? Because the data used to develop these scores reflect and perpetuate historic discrimination in housing, credit, and criminal justice. Credit-based insurance scores are biased on the basis of race because they reflect historical predatory lending and historical redlining in lending and housing. Consumer lifetime value scores are also, just like price optimization, are racially biased because they, reflect not only credit, for which is a major factor, but also other socioeconomic factors. And criminal history scores obviously reflect not just the historical, but the current bias in policing. So let's talk about how do we address this? And I'm going to take obviously a radically different approach from Daniel on this. and say that we should use a disparate impact analysis to address disparate impact. And there's a long history and many approaches to identifying and minimizing disparate impact in employment, credit, and in insurance. This is not new. There's a 30 to 40 year history of trying to identify this type of disparate impact in employment, credit, and insurance. And this was disparate impact as unfair discrimination has been recognized under the Fair Housing Act for over 30 years. The general principle is to identify and remove the correlations between the protective class characteristic and the predictive variables. So let's go back to our simple model, multivariate model. And instead of using a control variable for state, we use a control variable for race. So now what we're trying to do is we're trying to remove the correlations between our predictive variables x1, x2, and x3 in race. Well, what if x1, x2, and x3 are not perfect proxies for race, but still have high correlation? Then the disparate impact analysis in our simple model removes the correlation, and the remaining values for B1, B2, and B3 are the unique contributions of each predictive variable to explaining that outcome. The result is more, not less, accurate cost-based or risk-based analysis. So why is it reasonable and necessary to recognize disparate impact as unfair discrimination in insurance? Well, one, it makes no sense to permit insurers to do indirectly what they are prohibited from doing directly. If we don't want insurers to discriminate on the basis of race, why would we ignore practices that have the same effect? Two, it improves risk-based and cost-based practices. And three, in an era of big data, systemic racism means that there are no facially neutral factors. As Barocas himself noted, an algorithm is only as good as the data it works with. Often the patterns it discovers are simply pre-existing societal patterns of inequality and exclusion. Unthinking reliance on data mining can deny members of vulnerable groups full participation in society. I've already talked about some practices that raise concerns, but what's important is that it's reasonable and necessary for insurers to test for and minimize disparate impact in every aspect of their operations. Marketing is particularly important. Today's big data algorithms and variety of marketing channels give insurers, like other businesses, the ability to micro-target consumers. The ability to micro-target gives insurers the ability to attract or discourage consumers even before the pricing stage. And this is of course one of the reasons why Daniel's approach, the ultimate loss ratio approach, fails, because it relies only on an analysis of policies issued. At that point, you're already at the stage where people have been excluded through marketing or underwriting. Another example of an urgent area to do this type of analysis is claim settlement anti-fraud. Just as insurers use non-cost factors for price optimization and rating, so do they use non-cost factors for claims optimization. Anti-fraud algorithms, including those used at underwriting for propensity or fraud, are most vulnerable to racial bias. Historical bias in what claims to examine for fraud results in bias in claims identified as fraudulent. In other words, you get a self-fulfilling prophecy here. You can't identify a claim as fraudulent unless you investigate it. And then investments. Are insurers' investments perpetuating environmental racism, predatory lending, or other business practices that reflect and perpetuate systemic racism? So I'll finish there, but the bottom line is that systemic racism doesn't just affect pricing. Systemic racism really affects every aspect of an insurer's operations, and it's both reasonable and necessary for insurers to test all of their operations for systemic racism, for disparate impact. And getting back to what Daniel talks about as the terminus, For me, the terminus is that when insurers develop any kind of algorithm, any kind of practice, that it's part of their DNA to test for systemic racism. Whatever they're doing, whatever aspect of their operations they're engaged in, part of the development of that algorithm should be testing for racial bias and systemic racism. So I look forward to a further discussion. Thank you very much.
Thank you, Birny, very much for that. A lot of good information there as well. So Daniel taking some notes. I look forward to the two of you discussing uniform loss ratio in a couple of minutes, particularly. But before we get there, let's have Cassie talk a little bit about some work going on at within Oregon and across the nation. Cassie, the floor is yours.
Great. Thanks, Commissioner Stolfi. I'm Cassie Soucy, and I'm one of the senior policy advisors at Oregon's Division of Financial Regulation. And to kind of keep the conversation going about what we are doing practically in Oregon to address some of these issues today. So one of those ways that the department is examining its role in regulating the use of data and ensuring that discriminatory variables are not used is through our auto insurance legislative concept. So I think this has been mentioned, but a lot of insurance and auto insurance in particular, they use several different factors to rate a driver on their risk level and what the premium rate that the driver will pay. Currently, this includes information about your driving habits, years of driving experience, annual mileage, things related to your actual act of driving. The second bucket is insurance-specific factors such as insurance history, claims history, and the level of insurance coverage that the individual has had over time. And then that third bucket, which I think a lot of our conversation has been about, is demographic factors such as age, sex, gender, education, marital status, and location. Another one of those factors that is commonly used is an individual's credit history through a credit-based insurance score. So once all this information on an individual is collected, the auto insurer uses those rating factors in their underwriting process. Similar to what both Daniel and Birny touched on, is placing that individual into different risk categories, such as preferred group, which is the lowest risk, a standard group, and a non-standard. And this can look a little bit different depending on different insurers, but that gives you a good picture of how people are placed into groups. And we have learned since credit history first started appearing in rate filings in the mid to late 90s that it is poorly understood by most consumers, and it does have a discriminatory impact on low-income Black and Latinx consumers. So there are some issues with using credit history or credit-based insurance scores as one of the primary data points in creating the auto insurance premiums that everyone pays. So one of the first ones is no link to safe driving. There's accuracy and reliability problems. It's not well understood, and then there's that discriminatory impact. And a lot of this has come to light as data are becoming more comprehensive and these issues are highlighted, such as the conversation that we're having here today about the limits of algorithms and data, especially as they're used to the products we regulate and the products that consumers depend on. So to dive a little bit deeper into some of those factors, so no link to safe driving, several of the same data points that are used in creating a credit score are used in an insurance score with small differences in the weight they are given within the algorithm. And these are things such as payment history, outstanding debt, the length of your credit history, things like that. And risk, as I think both Daniel and Birny talked about, is the likelihood that an individual will file a claim and impact the insurer's loss ratio using that information and using the information based on financial measures. And those financial measures within the credit score or the credit-based insurance score are not tied to the individual's risk of getting into a crash. So a low credit-based insurance score can result in higher auto insurance premium, even if the consumer is a safe driver with a clean driving record. Moving on to accuracy and reliability issues, the FTC estimates that 1 in 5 consumers have an error in their credit report. And Black and Latinx consumers are more likely to have an error or insufficient credit history with their credit scores. There was an NAACP study that found that among households reporting poor credit, Black households were more likely to report that late student loan payments or errors in their credit report contributed to their poor scores. And focusing a little bit more close to home, about 1 in 5 adults in Oregon are credit constrained because of a limited credit history. So this could be no credit history or thin file, things like that. And one of the factors that plays into all of this is that following the economic recession, such as the one in 2007 and the one that we're currently in, we know that economic gains are not equitably distributed across all demographics. So keeping in focus on some of those factors, we also know that there's a discriminatory impact on Black, the Latinx community, and low-income consumers. And Birny touched on several of these things, that we know that these communities are targeted for predatory lending, and as a result have higher uses of high interest loans. And all of these financial factors influence an individual's credit history and credit-based insurance scores. Black, Latinx, and low-income consumers may lack the checking or savings account that allows them to gain access to those lines of credit that would improve their credit scores. And we all know that the past practice of banks discriminating against these communities by through historic redlining, these still impact these communities and their credit scores. So moving on to we know these issues exist, and what do we as regulators do about it? We have an auto insurance legislative concept. So we believe it is important to incentivize safe driving factors and to remove potential discriminatory practices that raise rates for Black, Latinx, and low-income consumers. As a state regulator for insurance and financial services, our legislative concept would create a fair auto insurance rating system based on safe driving behaviors and prohibit discriminatory auto insurance rating factors such as race, sex, gender, and employment status, and credit history. So these factors play a role in determining how much we pay for our auto insurance, but they are not actually related to our driving experience. So whether someone's a safe driver or not. And many of these rating factors do not have a direct relationship with safe driving behavior and penalize policyholders for their immutable and other individual characteristics. This is what the department is looking at moving forward. We will be introducing this legislative concept as a bill in our upcoming legislative session, which starts next week. We've engaged in lots of conversation outside of this specific conversation with industry, with consumer groups, really taking a focus to dive deep into the topic of the use of data and how it does affect the products that we do regulate. And I will add that in addition to our legislative work, the focus on reducing these disparities, and then also looking at the ways that we improve diversity. We internally have a diversity and equity committee that does work internally with our department. And in addition, there is national work that has started, as mentioned by Commissioner Stolfi at the NAIC through adopting the AI principles, but has also started through the Special Committee on Race and Insurance. So there's two work streams looking at these issues in overall, and the special committee is specifically examining issues related to diversity in the insurance industry and regulatory agencies, as well as the issues that we talked about today in terms of the data and algorithms that are used within property and casualty, health, and life insurance. And this includes, examining the data that's put into these insurance products and how it is used to evaluate whether those factors are inherently discriminatory, what the unfair impacts on certain populations may be, and whether data collection is needed to monitor those market outcomes. So continuing this conversation, and more importantly, the work in this area, is crucial to maintaining fair insurance systems for all consumers. It will take collaboration and open discussions similar to this one with insurers, regulators, and consumers at the table to succeed. So that concludes kind of my overview of what we are doing here in Oregon to address these issues, and looking forward to diving into any questions and the conversation that'll come.
Thank you, Cassie, very much. And thank you again to all the panelists for all that great information and for getting us started. So as I said, I'm going to try to talk very little here. There have been some great questions that have come in, and I will find opportunities to raise those to the panel. Encourage you, if you have a question, to get that into the Q&A still. But really want to kind of sit back and let the panel talk amongst themselves. If you have questions for each other, and I'll just help start it out by one question from the Q&A, and then please take it away from here. So Michael asks a question, talking about whether AI merely involves a large variety of rating variables rather than a few, noting how human actuaries have been minimizing bias for many decades, and asks, how AI is going to manage this.
Okay, this is Birny. I'm not quite clear what the question was. It sounded like it was more of a statement, but I think what the question recognizes is that insurers have, in fact, been utilizing big data to a greater extent to segment the population to a more granular, an ever more granular basis. So when Daniel talked about sort of phase 2 versus phase 3, I think we're really between those two. I think that insurers have moved to multivariate analysis. They've moved to more granular groupings. And while they're not at the full phase 3 that Daniel talks about, they're much closer to phase 3 than they are to phase 2. But it's still all done on an actuarial basis. And what's missing is that insurers have never addressed, or by and large, never addressed whether those practices have a disproportionate effect on racial minorities, whether there's a disparate impact, whether there is unintentional discrimination that's not necessary. And when I say not necessary, meaning it doesn't improve risk-based pricing, it distorts risk-based pricing. So that's why the approach that we suggest, requiring insurers to test for and minimize disparate impact, is really very consistent with what insurers are now doing in terms of their analysis. It's really just adding another control factor or control factors for the protected classes and making that part of the algorithm development.
Maybe I'll take us another step sideways on this one. So I agree with pretty much everything that Birny said, and Birny's incredibly thoughtful and well-informed on these things. I do think that the question isn't whether we should be looking at disparate impacts, but what disparate impacts we should be looking at. And I was suggesting loss ratio as an important one, and Birny said it fails. I think your argument was that it is incomplete, that it can help us with perhaps pricing and claims, but it doesn't take care of marketing and underwriting, and it doesn't check every stage in the life cycle of a customer with an insurance company. But I didn't hear an argument from Birny that it isn't a powerful tool for detecting unfair discrimination. I want to suggest that there is a broader point that we may or may not want to dive into, but it does preoccupy me. And here we start moving from the actuarial, frankly, to the philosophical and to the policy decisions. And I think regulators need to lead here. I have my own views on this, but there is a lot of debate today about the Martin Luther King dream. It is not as self-evident today amongst social justice advocates that is what they consider to be a desirable outcome. But if it is a desirable outcome, if that is where we want to end up, then I do think we have to take care to understand what times, what ills we're identifying where racism is a root cause, or where the race is itself a proxy for something else. I'll explain myself. It was noteworthy to me that Cassie several times in her comments spoke about Black, Latinx, and low income. Mixing between racial categories and class or wealth categories. Low income isn't a racial designation. But I wonder whether oftentimes when we talk about race, particularly about Black and Latinx, what we're really using is those markers as a proxy for wealth. And really, whether it isn't more helpful in some ways to look through a prism of class or money than race when we're thinking about these challenges. And Birny, I thought, spoke very thoughtfully about the sins of the past, the structural, formal racism that plagued America for so long through slavery and then through Jim Crow laws. But it begs the question, and it's no wonder, given that that's the legacy, that the median net worth of a family that is Black in America is 1/10 of the median net worth of a white family in America. But in trying to think about how we undo that, I would put it to this panel that it may be more important to look at class or wealth or low income as the primary indicator rather than skin color. And I make the case for two reasons. One is, again, going back to what is the terminus and the Martin Luther King dream. And I am uneasy, I'm not saying there's never a room for this, but I'm uneasy with the notion that we would take 3 kids of equal tough backgrounds, whether it's the neighborhoods in which they grew, measured by whatever, education level, crime level, wealth level, and we would treat them differently because of the color of their skin. I don't think that that is the Martin Luther King dream. I think the dream is that we will help all kids, in my example, of whatever their color of their skin, we will look at their circumstances and try to elevate the poorer people, the less advantaged people in our society. So I do worry about us over-indexing on race in trying to create a just society. And going back to my men-women thing, what we're really trying to do is to pierce through those relatively superficial trappings to looking at the circumstance of the individual. And so I always shift a little bit uneasily in my chair when we talk about those kinds of factors. And as I said, Birny talked about a theoretical situation where you have some factor that is a perfect proxy for race, and they're never quite perfect, but perhaps race is itself a proxy for another issue. And if it is, let's deal with that issue rather than stopping at the level of race. And the thesis that I was trying to advance is that data properly deployed, can help us do exactly that, can help us overcome those kind of biases, and not just say somebody is Black or white or man or woman, but look through at their individual circumstances, which I think is where we want to get to. That's the terminus.
I have a question, kind of based on what you were talking about, Daniel, about how do we get to know the individual with, like, what are those measures that we would employ to understand the individual factors within that phase 3? What do we need to capture the picture of an individual and the risks that they pose?
The other day I went onto my iPhone, I was looking to generate a power of attorney to pick something up from post office. And I just started, I put in the first 2 letters of the search and it completed it for me. Now, what a bizarre thing literally the first two letters, I was looking for a power of attorney to let somebody else pick something up from the post office. I don't know all the data that Google used to realize that that's what I wanted to do. But it's stunning, and we all get a little bit jarred every now and again when we see technology able to do that kind of thing. You know, we see today, we collect data as you go through the app, and we see interesting things. You can, and I'm not going to talk about Lemonade. I don't really want to talk about Lemonade, but just theoreticals in answer to your question. When you're in a digital infrastructure, people can come to an insurance company because they Googled cheap insurance, or they could come to it because they Googled good insurance. Is that a signal, or is that of no significance? And some of them will do it at 2 o'clock in the morning, and some at 2 o'clock in the afternoon, and some will read the policy before signing, and some will not. And some will ask questions, and some will ask no questions. And there will be myriad of those. Now, by the way, if that person was sitting in front of you, subliminally, you would use those things to form an impression about them, even though formally on the piece of paper that you fill out to sell them an insurance policy, it's not an official rating factor. But that's the kind of thing which big data does. And to Bernie's earlier point, we don't even know always in retrospect which factors it used in order to create a comprehensive picture. But as I say, if there's a way to audit the outcome, the disparate impact, then the more the merrier. The better I get at distinguishing you, Cassie, from somebody else who looks superficially like you, the fairer I'm being. That's my argument. And if I'm not using that data to sell you ads or to, but merely to give you the fairest thing I possibly can, to look down to the content of your character, I think that's a good thing. So long as I've been transparent and I've given disclosures and you've opted in, and there's all different things that protections that we put in place. That's the way I approach the question.
So this is Bernie, and I guess I'm going to depart from Daniel's position at some foundational levels. And I'll share my screen to do that. In Daniel's article, well, first I want to express thanks and appreciation for Daniel's thoughtful analysis and recognition of proxy discrimination in insurance. But I think the analysis fails for some core reasons. The first is that Daniel's foundational assumption is insurance is the business of assessing risk and pricing policies to match. And we just fundamentally disagree. For us, insurance is the business of pooling risk and transferring risk from the individual to the pool. That's what makes insurance an essential financial security tool. And while risk assessment and related pricing are part of how the industry carry out their business, the core function of insurance is risk pooling and risk transfer. Daniel suggests that machine learning can segment risk assessment beyond groups of similarly situated consumers to risk groups of one. The upshot is that today's coarse groupings are relentlessly shrunk until ultimately each person is a group of one. If we take this to the ultimate conclusion that each person is a risk group of one, we have perfect prediction of claims. Insurance is transformed from a risk pooling mechanism to a pay-as-you-go system. Excessive segmentation defeats the purpose of insurance. Ever more granular segmentation in marketing and pricing means greater extremes in terms of the price, affordability, and availability of insurance. And the folks who already have the most problems with availability and affordability are the ones who are most likely to be disadvantaged by greater and greater segmentation. Daniel sort of discusses the uniform loss ratio, but the problem with that is that unaccountable AI machine learning doesn't guarantee the correct risk characteristic or avoid disparate impact. It's also infeasible. The proposed method of measuring fairness has an internal contradiction. On the one hand, the ULR measures an individual outcome. A system is fair by law if each of us is paying in direct proportion to the risk we represent. That's what the proposed uniform loss ratio test tests. But on the other hand, the assessment of the ULR that Daniel proposes for fairness requires aggregation of dissimilar individuals into the same groupings that Daniel claims mask different risk characteristics. Simply put, if certain groups have a lower loss ratio than the population at large, that would signal that they are being treated unfairly. Well, the ability to assess ULR requires aggregating individual ULRs into selected groups. That aggregation of dissimilar risk creates the same problem ULR is attempting to address. The ULR approach is also inadequate because it fails to address systemic racism. For example, the algorithm will determine that a consumer living in a community of color has a higher likelihood of an uninsured motorist claim because there's a higher percentage of uninsured drivers in that community because of, among other things, income and wealth disparities due to historical racism and fewer competitive options due to insurance redlining. Well, this is an example of an unfair practice tied to a protected class characteristic, charging a higher price for communities of color because historic discrimination on the basis of race. So the idea that somehow an AI algorithm would figure this out isn't feasible. In fact, the AI algorithm would exacerbate this problem. And what that gets at is there are policy decisions to be made about what constitutes fair groupings for the purpose of assigning a premium. It's not simply a statistical analysis. What consumers should be grouped for the purpose of assigning a premium? What risk characteristics are in fact the ones that we want to promote? And that gets to the whole issue of sort of risk prevention. The reason that CEJ and Consumer Federation of America and others don't like the use of education, occupation, credit scores are because they focus on socioeconomic characteristics and they don't give consumers the ability to control their risk profile. There's nothing that really you can do about your race. So that's why, I mean, the reason race isn't permitted is because you can't change your race. But if you're, in terms of your credit score, what are you expected to do in terms of your credit score if you're the victim of an economic or medical catastrophe? If your business is closed down because of the pandemic and you're on unemployment and the federal government ends unemployment benefits and you're renting and you're thrown out, you're evicted, or you have a medical catastrophe but you've lost your insurance, why are these things somehow related to your ability to have an insurance claim or the ability to manage your finances? In other words, the sort of the policy aspects of risk classification really need to consider both sort of the fairness in terms of actuarial, but also fairness in terms of whether this is something that a consumer can control and whether it promotes the loss mitigation. The other, of course, I've talked about why the ULR doesn't address the other aspects of it, but one of the important issues that I want to address is that the ULR is based on an analysis of policies issued. This fails to take into account exclusion that occurs through marketing or underwriting. Stated differently, there's no guarantee that the policies analyzed for ULR reflect an unbiased group of policyholders or simply replicate the historical exclusion because of systemic racism. So while we certainly are proponents of big data, we think that disparate impact is consistent with that. We don't like the idea of willy-nilly banning or prohibiting particular rating factors because we think that those rating factors might be discriminatory on the basis of race. What you do then, let's say you ban credit scoring, or you ban employment, or you ban education levels. What you're doing is you're using a proxy for race and banning that proxy. So there are three problems with that. The first is it's a whack-a-mole approach because the insurers are going to replicate the same outcomes using a new data source. So already insurers are now using online behavior. They're collecting data from how you interact with an insurance application online and analyzing that to make decisions about you. The second is that banning factors based on expected disparate impact is a crude approach. Requiring insurers to identify and minimize disparate impact is a more direct approach to addressing systemic racism and focuses the public policy discussion of rating factors on issues of fairness other than actuarial fairness. And the third is that any effort to address systemic racism has to address marketing and underwriting, claim settlement, as well as rating. Limiting protections simply to rating creates a loophole, and you exclude, and the ability of insurers to exclude and channel consumers on the basis of protected class characteristics through marketing. So for those reasons, that's why we think sort of a general requirement for insurers to look at and minimize disparate impact is really a much more direct and statistically accurate approach to really addressing systemic racism.
Birny, I'd love to address some of your points.
And Daniel, yeah, please do. And if you could do, I mean, I'll tie in a question that came in from the chat, which directly hits on one of Birny's points. You know, someone asked, you know, if someone lives in a low income neighborhood, there could be a higher risk of their car being stolen, which has nothing to do with the content of their character. And, you know, how does that get accounted for, you know, in these models and discussions? But please, you know, talk about that and Birny's comments as well.
Thank you. So one is, Birny, I perhaps didn't do a good job in articulating some things now or in my written essay, because I, of course, agree with you that insurance is the business of pooling risk. And I don't think that the idea of getting to a group of one, maybe my terminology failed here, but I don't think that is instead of risk pooling. Insurance remains the business of aggregating premiums in order to pay claims. Because even in my theoretical terminus, we won't know that a particular, we'll know about probabilities, we won't know about actually what happens. There will still be chaotic things in the system. So I'll be able to know with what likelihood I or somebody else will have some kind of an incident, even in the theoretical endpoint. I won't know with certainty, which is why insurance survives, which is why pooling survives. The question that I think the phase 3 can address is, of course, we're going to pool premiums to pay claims. The question is, what will you charge me to join that pool? And my argument is that phase 3 can bring us ever closer to the point where what you charge me in, you know, what I contribute to the pool is in direct correlation to what the risk I introduce into the pool. And I think that is where we want to go. I don't think that lives in tension with what you were saying, but certainly I understand that pooling survives. I never meant to imply differently. I merely want to get as fair as possible in my pricing. And I think that the better we get in doing that, a lot of things happen, the less racism there is. I'll talk a second about systemic racism, as you call it, but certainly there won't be bias in the system if we get good at that. In theory, if that's where we want to end up, that is a place where we will be charging people in a way that is, I've been using loosely the content of your character, but to be more precise, in direct correlation to the risk that you introduce into the pool, regardless of your gender, or your color, or your sexual orientation, or your age, or anything else. It will just be looking at the risk that you introduce into the pool. I have to say, I think, Birny, that we agree on more than we disagree, but I still feel that a test like the uniform loss ratio goes a long way towards helping us. I think regulators today are hamstrung in their ability to check bias. We submit in states across the union a bunch of rates and forms. We don't have good tools for assessing whether the rating factors that we're introducing are perfect. We certainly hope they are. Regulators don't either. And I think an algorithmic way for determining whether, in fact, people are paying a commensurate amount to the risk they introduce, ULR passed that test nicely. And it does it, by the way, not just on rates, but on claim settlement. It ultimately looks at the totality of your life as a customer. I think you're quite right that it does not address whether I didn't include you as a customer to start with. We'd have to find another system for that, but it does check whether or not, as a customer, I'm treating all my customers in a way that is commensurate with the risk that they introduce. So I'd put it to you that it is incomplete rather than flawed. Certainly not a panacea, but as I say, trying to move the debate forward. I absolutely agree, Andrew, to the question. I think another place where the proposal is incomplete is the social responsibility aspect here. And here I come back to Bernie's point about systemic racism and to your questioner's question. I'm a big believer that the notion of a self-made man or whatever, self-made person is a fiction. I think that we're all the byproduct of a combination of nature and nurture, and we can take no credit for either one of those things. We are born with certain physical and DNA and genomic factors, and the rest come from the environment in which we grew up. And actually our ability to attribute to ourselves agency is, to my mind, massively overrated. I think humanity has much more that is predestined than we would like to imagine, in fact. And to my way of thinking philosophically or ethically, that imposes a greater responsibility on those who are doing well to share with those who are not doing well. The behind the veil of ignorance, if you use that test, we'd all want to be born into a world where if we were poorly equipped in terms of nature and nurture, society at large would distribute the plenty in a way that works for everybody. So I am minded to say, I think there are two tiers here, and Bernie, in a slightly different vantage point, spoke about these. I think number one, the game of pricing and underwriting risk, we should use technologies in order to get ever closer to a fair price in terms of matching risk into the pool. And I propose that big data and machine learning takes us a long way there, and that ULR can audit it. I do think there's a whole nother tier that we must introduce above that. And I don't think this falls to insurance companies. I think it falls to regulators to do this. And I don't think that this is predominantly on race. I think this is much more, again, to do with class or with circumstances. But people who are in neighborhoods that are of high crime, for example, it's not their fault, to your questioner. They are in a situation where they don't have all the protections of others. And ironically, they will be at more risk. Even though they are low income, they will end up being charged more by my system for burglary insurance, because they have circumstances where they've got high crime in their neighborhood and they don't have a guard at the door and all these other things that people with wealth might be able to cater for themselves. And therefore a system where regulators imposed some form of redistributive justice, where a certain amount of premiums for higher, for people with better risk circumstances was used to subsidize other premiums, would, to my mind, be a goodness. I do not think you get there by just having a bad version of risk pricing. You do that by pricing risk as best you can, and then clearly, explicitly, and externally imposing, much like a tax does, a tax on higher premiums in order to help people in other circumstances. We're speaking about property and casualty, but health insurance. People are born with terrible health conditions, and they would never get coverage if you took the pure and the harsh version that I'm getting at. So I do think there's two systems. One, use technology to get as fair as you can by breaking up groups, pricing people based on the actual risk, and then build another floor on top of that where government comes in and says, all well and good that you've got this perfect system, but I now want some form of inclusion and communal responsibility, and I'm going to layer that on top. And as I say, don't leave that to insurance companies, because competitive dynamics will preclude them doing a good job on that.
So I'll jump in with a couple of points. This started with a question about car thefts in low-income areas. And what that triggered for me is that I think that's probably a biased assumption. that there are more car thefts in communities of color. And points to the importance of the disparate impact analysis, not just to overcome bias in data, but also bias in modelers. We all bring our biases to the table. If I'm an anti-fraud examiner or investigator, I have some ideas about where anti-fraud is likely to occur, and I end up looking for information that confirms my beliefs, and I tend to give less weight to information that doesn't. So I'm with Daniel on the use of analytics to root out bias, not just in data, but bias in modelers. I'm also with Daniel that I don't want sort of efforts to address affordability issues to distort the cost-based pricing of insurance. Cost-based pricing of insurance is critical to give consumers and businesses the proper price signals for whether they can afford to live in a catastrophe-prone area, or what the costs and cost benefit of investing in loss mitigation would be. We've seen firsthand the disaster, the financial disaster of mispricing insurance through the National Flood Insurance Program. So that providing assistance to consumers who can't afford insurance should be a public policy decision, and should be, and that assistance should come outside of the pricing system, in the same way that the assistance for people who have a hard time affording health insurance comes outside of the ACA pricing system. I don't think you can layer that assistance on type of pricing, but I think what you can do is you can look at your risk segmentation, and you can analyze those in terms of public policy standards and public policy goals. Do these risk classifications promote loss mitigation? Do they empower consumers to modify their loss profile, to avoid risky behavior? And there's some risk classifications that clearly fail those standards, but you have to articulate the standards that you want risk classifications to be evaluated on the basis of. And I guess the last thing that I'll say is that it's really important to think about pricing in much broader terms than just rating factors. We saw, and I saw this firsthand, but when insurers started introducing what they called tier placement factors, one of the anomalies of the US insurance rate regulation system is that property casualty is that companies typically didn't submit underwriting guidelines, and so regulators didn't have them. They submitted rating manuals. So what insurers did when they wanted to introduce credit scoring without scrutiny is they said, well, we are introducing tier placement factors. We're going to call that underwriting, but it's going to be that step between our original underwriting and our rating factors. And since we're calling it underwriting, we don't have to submit this. So the result is that the actuaries at their rate making seminars had sessions on how to utilize tier placement factors to avoid regulatory scrutiny. So the lesson for me there is that unless you look at sort of pricing in a very holistic fashion, from marketing through underwriting through rating factors, you're going to create loopholes for insurers to game the system. And again, the idea that whacking one particular rating factor is going to somehow solve the problem isn't going to address the issue of new data sources that are going to appear all the time because of the ability of whether it's data brokers, mobile providers, website managers, Amazon, Google, whoever, to collect data and then make those data sets available. When you look at TransUnion, LexisNexis, they are constantly developing new scoring algorithms, new tools based on either different types of analysis of credit or combining credit with new types of data, whether it's new criminal history scores, whether it's online behavior scores. They're constantly developing new tools to do that. So we have to have a holistic approach that doesn't allow those loopholes.
Birny? So I'm going to try to weave a few of the questions that came in into one, and maybe ask you to talk about your views around the future. Let's look way into the future and what limitations or maybe even potential dangers there might be in thinking about AI as the solution. And we talk about being able to create a system that can perfectly predict claims, right? And I've seen the movie Minority Report, and I know the dangers of trying to perfectly predict the future, right? And there's some questions that came in around why are we going to need insurance? And isn't this just self-insuring, and people who are found through these algorithms and through AI to have a likelihood of a claim can just deal with that on their own? Can you talk about that and looking into the future, what you think maybe the limitations of this are, and are we going to need insurance in 100 years from now?
Sure. So of course we're going to need insurance. It's the ability to pool risk and transfer that risk from the individual to the pool is essential. It's going to continue to be essential for individual, commercial, and community economic development. It's a way we build resiliency and sustainability, and it's going to become even more important in an era of climate change, because it's going to be essential for providing those price signals for investing in loss mitigation. But the issue, I think the problem with that question that I see is that it's sort of grounded in the foundation that Daniel talked about, where insurance is in the business of assessing and pricing risk. As long as we sort of start from that foundation, then we're always going to sort of go down that road of how much segmentation do we get. If we start from what I think is the more correct proposition, that insurance is the business of pooling risk and the transfer of that risk, then when we start thinking about AI, it's not a question of reining in AI. It's a question of what are the goals? What are the goals and dreams that we have as a society? And then what are the tools that we need to get there? And I think the NAIC AI principles do a really good job of saying this is how we have accountable and ethical AI. If we have AI where insurers are proactively trying to address proxy discrimination, if it's accountable, if it's understandable, if it's transparent, then I think all of those things are consistent with a public policy-based approach for insurance that says we're going to think about risk segmentation and risk classification in a way that balances our public policy goals, not just of fairness in pricing, but also in risk mitigation and fairness in terms of our racial past.
I'll take a stab at kind of the question about where do we see the future? And I think Daniel touched upon this of the fact that, in the last 10, 20 years, there's been such great advancements of technology and the ability to collect data to inform our decision making, and that continues to this day and will continue to propel us forward. And I think, as we continue to have these conversations, especially looking at AI and the data that we use and potential algorithmic bias, there's a lot of opportunity, not just for our industry in insurance, but a lot of industries overall, for collaboration, for building upon the skills that everyone brings to the table, whether it's in, insurance underwriter to a regulator, to experts who know the ins and outs of AI and can tell us more about it. But I think, looking to the future, that collaboration and continue in having these conversations as more and more elements of AI and data get built into the systems that we have in society will benefit us all and will help us continue kind of these good conversations that think critically about the benefits and the limitations of the things that we use to make our decisions.
So maybe build on that. There's another question. This is interesting. Talks. Mentions how the terminus, Daniel, of your argument is a place of perfect knowledge, and whether we can ever get there or not is one thing. But if we were, and insurers were able to predict to that great degree. So if hypothetically, if perfect knowledge were achieved, would that argue then for a public single payer system? The system now of risk pooling is predicated on the concept of uncertainty. So the closer you get to certainty, does that then weigh in favor of some public process? What are your thoughts on that?
I think it's important to distinguish between perfect understanding of risk and the minority report scenario of knowing what the future will be. If I roll a dice, I go to Vegas, there's nothing unknowable to perfection about the risks that I'm taking there. It's just a perfect knowledge situation. If the dice are fair dice and I roll them, you can compute it with certainty. And AI could tell you that, but you don't need AI to tell you that. It doesn't mean that it will know if it will come up sixes or not. It is an inherently unknowable thing. It is chaotic or random, and the percentages, the likelihoods are known, but the outcomes are not. Now, even in my theoretical, and it is theoretical, terminus, where I knew I could say to the umpteenth decimal point, what is the likelihood, Andrew, that you will, that I will have a car crash today, and you say it's going to be a 23.67% likelihood, that doesn't mean that I'm going to have a car crash or won't have a car crash. So I think uncertainty is going to be part of our universe forever and a day. The place that we want to get to is not just saying, Andrew's a man, Daniel's a man, Birny's a man, men drive badly, let's charge them twice as much as we're going to charge Cassie in my extreme alternative example, but to get closer and closer to that 23.67 and to distinguish between all different people and to abandon the class and not class, well, to some extent, but the race and the gender and the other things that loom so large for us today, and to be able to go through and get down to that number, which doesn't matter whether you're black or white or male or female, you're a human being driving a car. Let's assess that risk and let's ask you to contribute to your pool of fellow humans in a proportion that is directly representative of the risk that you introduce. So I hope that helps. I don't think that at any point we have perfect knowledge. Theoretically, we'd have perfect statistics, but that doesn't stop you needing to pool money and to take care of eventualities that are beyond your control.
Thanks, Daniel. So another question that came in, we're talking a lot about what insurance companies are going to be utilizing AI for. What do you see, or will there be a need for regulatory AI, for regulators to have their own artificial intelligence in order to understand what the industry AI is doing and how much should this be confidential or not?
So I can take a run at that. And the contribution I'm trying to make to this discussion, it seems like I've abjectly failed, at least when it comes to convincing Birny of any of this, but maybe somebody else on the Zoom today will find it somewhat helpful. To my mind, we do want to look for algorithmic ways that allow you as a regulator to monitor me as an insurance company. And I actually think that the status quo, we can talk about all the concerns that we have about big data, and we should, but we have to weigh those up against the very imperfect system that we have today, which is that today your ability to know my ability to know, your ability to know the fairness of my system is very, very limited. And I don't accept the premise, I think, that underlines a lot of what Birny is saying. That is, if we look at disparate outcomes in pricing, that will lead us somewhere good. I think that will lead us astray for the reasons that I tried to articulate. I think that humans on average can represent different risks in ways that are unimportant. What is important is to pierce through those and look down to the individual. I hope I've made that case. So the ULR is exactly an attempt to give you, Andrew, a tool to audit me, an insurance company. And I put it to you that if you required of me quarterly reports that said, what is your loss ratio? And you'll decide the frequency and you'll decide the protected classes. But I would at least like to see loss ratio reports based on age, gender, wage. It doesn't have to be formal protected classes, whatever you think is important for you as a regulator to ensure fairness. And then you look at those and you say, 1 second, Daniel, it looks to me like you are overcharging people of color because their loss ratio is lower than white people. And Birny previously kind of attacked that and said, oh, you're aggregating people. I am for the purposes of auditing, not for the purposes of pricing, but for the purpose of giving you a tool to say, it's wonderful that you're claiming to price to precision. Is there in fact inherited bias, proxy bias, or the other biases in there? And I say, I present to you a tool that will be able to give you a real-time reading on whether or not that is the case. I still think we have to solve the problem of marketing, but I actually think that goes a long way towards resolving it and doesn't actually require you to develop AI, because I think you can impose that burden on me. You can say to me, these are the ways I'd like the data presented to me. Ultimately, I think you can ask for them in real time. These don't have to be quarterly. In my mind's eye, you have a dashboard every morning, and it gives you an alert that this insurance company has now deviated more than 2 statistical whatevers when it comes to pricing, risk, and et cetera. And you really get a dashboard that shows you. I think that is the place that you want to end up, and you can impose the AI part of it on me.
So this is Birny. While I certainly have some disagreements with Daniel's approach, I'd say that we are quite close compared to the industry trades positions on this. For example, Daniel's suggested approach for regulatory monitoring is sort of a big data approach. It's getting information to regulators, lots of information to regulators in a sort of timely fashion. And that's been part of the sort of the 2-prong effort that we've been pushing for many years. The sort of the companion to requiring insurers to do disparate impact analysis and minimize that is for regulators to develop a regulatory data collection system that allows regulators to do the same types of sort of AI and data mining type of analysis that insurers do. Whether that's using that to identify producers who are outliers in terms of the sale of index universal life insurance, or whether that's insurers who primarily serve non-standard markets and have differences in claim settlements. But the ability to sort of analyze large volumes of actual consumer market outcome data should be in the toolbox of regulators. And I guess the contrast couldn't be made more vivid than compared to what the NAIC did in its auto insurance affordability and availability study, in which they collected, very highly aggregated data from insurance companies at distant historical past and only for policies that were issued, and assume that that was somehow sufficient for regulators. We think that regulators should be collecting data at the transaction level, both in terms of applications, sales, and claims, and doing the types of big data analytics that insurers engage in, except from a regulatory perspective.
Thanks, Birny. So we're getting to our last couple minutes here, and I want to leave you all an opportunity to give your closing thoughts. Maybe I'll do a little bit of a lightning round, try to quickly raise a couple questions that have been asked. If you can give a quick response to that if you have one. First, so Michael asked, Birny described a linear formula for using rating variables. Can AI use non-linear models? It's a technical question, if anyone knows the answer to that.
Sure. Well, the answer is yes. And that example was a simple linear model, but that can be easily transformed into a nonlinear model. It shouldn't be taken as any kind of analysis of insurance rates requires a linear model.
So Bob asked, doesn't a uniform loss ratio finding that a class is being overcharged lead to a correction by a large class, making the idea of individual pricing broken down?
I think that's a great question. I struggle with that one. I think that is unsolved in my system, actually, which is, what do I do the next day? If you tell me, okay, Latinx people are being charged 12% more, what do? Do I introduce 12% discount across the board for Latin people? I'd have a real problem with that. But what I certainly would do is try and look through my systems to try and find where is that proxy or other bias in the system and eradicate it. And you would hold me to account until I deliver that. But I don't have a acute answer to that question. I think it's an important one.
Great.
Well, I do have an answer to that question, which is the way to find that discrepancy is through the type of disparate impact analysis that I talked about earlier. And instead of sort of going through an interim step of the ULR, we'd suggest go right to the disparate impact analysis. And because if you find something, you're going to have to go there anyway. So why not go there in the first place?
Just because, as I've tried to make the case, the fact that Latinos are being charged more doesn't mean there's anything wrong. It's only when you compare it not simply to the pricing, but to the claims payouts that you know whether the extra pricing is reflected in extra claims payments, which is why I think you need a more systemic approach. That was the case I was making. I'll be back to you.
Oh, and I agree. It's just a disparate impact analysis doesn't exclude the consideration of the outcomes. It specifically includes it, but it tries to sort of identify what's explaining that outcome. And to the extent that race or some other prohibited class characteristic is explaining that outcome, it tries to figure out a way to exclude that portion of the explanation from the other variables. But I did want to take just a quick minute to thank Cassie and Daniel. I would say that if the rest of the insurance industry had the same ideas and views as Daniel, we would be in a completely different world. And I'm really grateful for the contributions he's made. And I'm also incredibly impressed with the company that he's built. So thank you very much.
Oh, thank you. That means a great deal coming from you, Birny, and right back at you. Keep us honest.
Well, that's maybe a good transition to maybe what might be the last question. I'll try to combine two here. Do you think that insurers are currently well equipped to test the impact of big data to fight for systemic racism? Maybe related to that, someone asked whether insurance companies should be required to collect information about a consumer's race, I'm assuming in order to make sure that there's no proxy discrimination.
So the answer to the first question is yes, of course they're equipped. I mean, if you have the ability to develop a complex algorithm based on an analysis of big data, whether that's using generalized linear models or Bayesian models or any of the other approaches, you certainly have the ability to consider whether your data are biased on the basis of race or whether your algorithm is biased on the data of race. And there are a variety of ways to do that. They all generally require attaching some the protected class characteristic to the transactions that you're analyzing. And the argument that insurers make is, oh, well, we can't collect that. Well, you don't have to collect that. There are ways to generate a proxy for that. For example, folks have often used the racial characteristics of a census block, but even that, there's been advances based from that. The Consumer Financial Protection Bureau has come up with a methodology that combines census block racial characteristics with last name analysis. So yeah, it may not be perfect, but then again, the most other insurance data are also not perfect. And the fact of the matter is that it's not a valid excuse for failing to try to address these issues. The other point that I would make on this is that you have data vendors, data brokers out there who will basically collect volumes of information about consumers. And they're clearly in a position to produce a data set of racial characteristics associated with individual consumers. If the industry demanded that, then the market would respond to that for purposes of this. So I just think that there are lots of options. The industry isn't doing it now, so it's unfamiliar with them, but it's certainly not out of the range of possibility. And I'd stress that the type of disparate impact analysis that we're talking about has been done for over 30 years here, and it's being done in Europe. They test there for gender discrimination. So it's possible. Where there's a will, there's clearly a way.
I'll just add, I think everything Birny said is right, but I have to say that from my seat, I approach this with some trepidation. So I've been wanting to do this, and I looked, for example, at the data sets or the proxies that are used by the housing businesses, and using census block combined with surname to produce a percentage likelihood of somebody being Hispanic or Black or what have you. And this is, again, maybe somewhere where regulators can come in. I think that these are very delicate issues and very delicate times. And the idea that I would just have a database where I've ascribed to each of my customers a percentage likelihood of them being Black or brown or something else is something that has to be really approached with tremendous care. I must tell you, we reached out to the ACLU and asked them if they would accompany us on that journey, because our intentions are pure, but we want to do it in a way that involves the community and feels right. And we haven't yet cracked the code on it. So I agree with you that the data exists and that the methodologies are out there. I, as a CEO of an insurance company, haven't found a path forward to do that in a way that will reassure customers who didn't tell me their race that I'm using this information that sits in a database for benevolent rather than malevolent causes.
So, I mean, would it be that all insurer CEOs would be as conscientious and sensitive as Daniel? But think about the types of data that insurers already collect about consumers without their knowledge or consent. Social media data, and I can collect any information I can get from Facebook or Twitter or others, or I can get your credit information, all that personal information there. They don't think twice about that being as well. I wonder if that's going to raise some concern among consumers or politicians. But somehow, when it comes to race, explicitly for purposes of fighting racial discrimination, somehow, well, that's a bridge too far. So I'd like to sort of put that in the context of the other types of data that insurers routinely collect about consumers without consumers' consent.
Fair enough.
Well, thank you all. And unfortunately, we've reached the end of our time. These are discussions. I know we weren't going to get to a conclusion on everything today. Sorry to the few of you who have questions there that we were not able to get to. Want to again give our agency's sincerest thanks to Daniel, to Birny, to Cassie, and to all of you for joining us and engaging in this discussion today. There's a lot of work taking place in this area, and it's going to take all of us working together to ensure that we realize the full potential of AI in a way that's safe, secure, and equitable for all. So thank you again. If you want more information on the work that we're doing on innovation, please visit our website, dfr.oregon.gov/innovation. Thank you again to our panelists and those who listened. Have a great rest of the week.